4.7 billion. That's how much Bitcoin BlackRock and institutional whales absorbed in a single day while you were panic selling. February 6th, 2026. Exactly, 66,940 Bitcoin disappeared from exchanges. Not lost, not hacked, systematically transferred from retail investors' wallets into institutional cold storage. While the Fear and Greed Index hit capitulation levels, while Reddit was screaming, "It's over," while your portfolio was bleeding red, BlackRock was executing the largest single-day accumulation we've seen since 2022. This isn't speculation, this is blockchain forensics. Public ledger data from CryptoQuant, Glassnode, and Whale Alert. Numbers you can verify yourself right now. And if you think this was just another market correction, I need you to listen very carefully to what I'm about to show you. Because while you were watching the price, BlackRock was watching something else entirely, the supply. And they know something most retail investors don't. Every Bitcoin cycle follows a precise four-stage pattern. Same warning signs, same player behavior, same devastating outcome for those who don't recognize it. By the end of this video, you'll understand exactly what BlackRock saw on February 6th, why they moved $4.7 billion in 24 hours, and most importantly, what comes next. Because there's mathematical evidence here. Historical precedent spanning 3 complete Bitcoin cycles that proves this exact setup leads to 70% to 370% returns within 6 to 18 months. The only question is whether you'll see it coming, or whether you'll be asking 6 months from now like millions before you, how you missed all the signs when they were right there on the blockchain. Transparent, documented, undeniable. Stick with me. The next 18 minutes will change how you think about Bitcoin forever. But before we dive deep into the data, I want to know something. Drop a comment right now telling me what city you're watching from. I'm fascinated to see how global this community is. Are you watching from New York at 9 a.m., London at 2 p.m., Singapore at 10 p.m., Tokyo at 3 a.m.? Let me know in the comments. And if this video is already opening your eyes to what's really happening while mainstream media feeds you the same recycled narratives, smash that like button right now. It tells YouTube to show this to more people who need to see it. And subscribe with notifications on, because what I'm about to show you in the next segment will blow your mind. The historical pattern that's repeated 3 times and is happening again right now. Let's go. Here's what nobody's telling you about February 2026. While Bitcoin ETFs bled $1.6 billion in outflows, on-chain data showed something completely opposite happening. The accumulation trend score hit 0.68, the highest level since November 2025. Let me break that down in plain English. The accumulation trend score measures whether Bitcoin is moving from weak hands to strong hands. Below 0.3 means distribution, selling pressure, bearish. Above 0.6 means broad-based accumulation, institutions buying, bullish. We hit 0.68 while the price was dropping. Here's the paradox that reveals everything. ETFs lost $1.6 billion. Retail investors sent over 100,000 Bitcoin to exchanges to sell. The fear index crashed. Mainstream media screamed crypto winter. Every signal you were taught to watch said, get out. But BlackRock, they did the exact opposite. BlackRock linked wallets moved $247 million to Coinbase Prime Custody on February 9th alone. Then on February 6th, the largest single-day whale accumulation of the entire cycle, 66,940 Bitcoin, $4.7 billion at $70,000 per coin. This exact divergence, retail panic selling while institutions accumulate, has happened 3 times in Bitcoin's history, 2015, 2018, 2022. Each time, it followed the same 4-stage cycle, and each time, those who recognized the pattern made generational wealth. Let me show you the mathematical pattern that governs every Bitcoin cycle. Stage 1, retail capitulation. A major market event triggers panic. Mt. Gox, ICO bubble burst, FTX collapse, Luna implosion. The headlines turn apocalyptic. Bitcoin is dead articles multiply. Short-term holders, people who bought in the last 155 days, send Bitcoin to exchanges. They realize losses. They exit. Fear dominates decision-making. This phase typically lasts 30 to 90 days. Stage 2, silent institutional accumulation. This is the critical phase most people miss. While retail sells, institutions buy, but not on exchanges where it moves the price, through OTC desks, into cold storage wallets that won't move for years. No announcements, no CNBC interviews, just systematic absorption of supply. You only see it if you're watching on-chain metrics. Accumulation addresses, exchange balance drops, whale wallet growth. This stage lasts 60 to 180 days. Stage 3, the compression. Supply on exchanges hits multi-year lows. Liquidity thins dramatically. Price consolidates in a tight range while leverage builds on both sides. Longs betting on recovery, shorts betting on continued decline. Volatility compresses like a coiled spring. The market gets boring, attention fades, but underneath the supply shock is building. This stage lasts 30 to 90 days. Stage 4, the violent breakout. A catalyst triggers the move. Could be macro news, could be a technical breakout. The price explodes in one direction, liquidations cascade, short squeezes amplify momentum. Everyone who sold during stage 1 watches in horror as Bitcoin rallies 70% to 370% in months. This stage is fast and brutal, 30 to 120 days. Now let me prove this isn't theory. This is documented historical fact. Now, if you're starting to see why the mainstream narrative is completely backwards, if you're realizing that panic selling is exactly what BlackRock wants you to do, hit that like button right now, seriously. It takes 1 second, and it helps this video reach more people. And drop a comment telling me, have you ever panic sold Bitcoin or any crypto? Be honest, there's no judgment here. I want to know if you've been on the wrong side of this transfer before, because understanding the pattern is the first step to never making that mistake again. Subscribe if you haven't yet, because I'm about to walk you through 3 complete historical cycles that prove this pattern with undeniable data. You don't want to miss this. 545, 0830, Prova Historica 1, 2015, Upadronasa 2015, the Mt. Gox aftermath, February 2014, Mt. Gox, handling 70% of global Bitcoin volume, collapses. 850,000 Bitcoin gone, the largest exchange failure in history. Bitcoin crashes from $1,000 to $200, an 80% drawdown that lasted over a year. Stage 1, verified. Throughout 2014, retail capitulated in waves. Exchange balances spiked as panic sellers deposited coins. Transaction volumes dropped. Hash rate uncertainty increased. Mainstream declared Bitcoin finished. Pure, unfiltered fear. But stage 2 was active in the shadows. August 2015, on-chain data showed a critical shift. Large wallets, addresses holding 1,000 plus Bitcoin, started accumulating aggressively. Accumulator addresses absorbed over 200,000 BTC between August and December. And here's the institutional proof. Tim Draper, billionaire venture capitalist, bought 30,000 Bitcoin in the U.S. Marshals auction in July 2014. While retail was screaming scam, Draper was writing checks at $600. Barry Silbert's Bitcoin investment trust accumulated throughout 2015. Institutional custody infrastructure was being built while retail was still traumatized. Stage 3, January to October 2016. Bitcoin consolidated between $350 and $450 for 9 months. Boring. Flat. Media attention evaporated, but exchange balances kept dropping. The spring was compressing. Stage 4, November 2016. Bitcoin broke $500, then $700, then $1,000. By January 2017, that breakout was the beginning of the 2017 bull run that took Bitcoin to $20,000. Those who accumulated during 2015's fear, they saw 10,000% returns. Complete cycle, documented and verified. 2018, the ICO bubble implosion. Bitcoin peaked at $20,000 in December 2017. 12 months later, December 2018, it had crashed to $3,200, an 84% drawdown. Hundreds of ICO projects went to zero. Exchange hacks multiplied. Regulatory crackdowns intensified. Mainstream media declared Bitcoin dead for the 100th time. Stage 1, confirmed. Throughout 2018, short-term holders capitulated in massive waves. Over 500,000 Bitcoin moved to exchanges between January and November. Realized losses hit record levels. Miners shut down operations. Bitmain canceled its IPO. The sentiment was apocalyptic. But stage 2 was already underway. December 2018 through June 2019. On-chain accumulation signals flipped decisively positive. Whale wallets holding over 10,000 BTC increased holdings by 12%. Accumulation addresses absorbed coins at $3,000 to $4,000. Prices that seemed expensive at the time but were generational buy opportunities in hindsight. The institutions? Fidelity Digital Assets launched custody in October 2018. Bakkt announced Bitcoin futures. ICE was building infrastructure. While retail nursed wounds, Wall Street was positioning. Stage 3, April to September 2019. Bitcoin consolidated between $8,000 and $12,000. Tight range, volatility compression. Exchange balances declining month after month. Supply shock building in plain sight for anyone watching on-chain data. Stage 4, October 2019. Bitcoin climbed steadily, $10,000, $12,000. By February 2020, Before COVID even hit markets, Bitcoin was at $10,500, up 230% from the lows. Then, after the March 2020 COVID crash got absorbed by institutions, the real explosion began. Bitcoin hit $69,000 by November 2021. Those who accumulated during 2018's fear saw returns exceeding 2,000% in less than 3 years. Same pattern, same stages, same outcome. If you're seeing the pattern now, if you're understanding that this isn't random but mathematical, make sure you've liked this video. I'm spending hours researching this data, pulling blockchain metrics, verifying every number so you don't have to. The like button is how you tell me this content is valuable. Comment below and tell me, which cycle did you live through? Were you around for Mt. Gox, the 2018 bear market, FTX, or is this your first real cycle? I want to know your experience because it shapes how you see what's happening right now. And if you're not subscribed yet, what are you waiting for? The next historical example is the most recent and most relevant to what's happening in February 2026. You need to see this. 2022, the FTX catastrophe. Lunaterra imploded in May 2022, wiping out $60 billion. Three Arrows Capital liquidated in June. Celsius, Voyager, BlockFi all filed bankruptcy. Then, in November, FTX, the second largest exchange in the world, revealed as a complete fraud. Sam Bankman-Fried, arrested. $8 billion in customer funds missing. Bitcoin crashed from $69,000 to $15,500, a 77% drawdown. Stage 1, brutal and documented. Between May and December 2022, the retail exodus was catastrophic. Over 700,000 Bitcoin flowed to exchanges. Short-term holders realized losses exceeding $40 billion. The fear and greed index stayed in extreme fear for 7 consecutive months. Coinbase stock dropped 85%. Everyone thought crypto was finished for good this time, but stage 2, the institutional accumulation phase, was the most aggressive we'd ever seen. December 2022 through March 2023. Whale accumulation addresses absorbed Bitcoin at unprecedented rates. Glassnode data shows accumulator wallets added over 400,000 BTC during this 4-month window. And the institutional buyers? MicroStrategy bought 2,500 Bitcoin in December. Michael Saylor on CNBC were buying the dip. This is the opportunity of the decade. El Salvador kept stacking monthly. Institutional OTC desk volumes increased, while exchange spot volume collapsed. The smart money was loading up. Stage 3, April to September 2023, Bitcoin consolidated between $25,000 and $31,000 for 5 months. Range-bound. Media attention faded completely. Mainstream forgot crypto existed. But exchange balances hit 5-year lows. The supply squeeze was setting up perfectly. Stage 4, October 2023. Bitcoin broke out violently, $35,000. Then BlackRock filed for a spot Bitcoin ETF, $45,000 by December. The ETF approvals came in January 2024. Bitcoin exploded to $73,000 by March 2024. Those who accumulated during the FTX fear saw 370% returns in just 16 months. 3 complete cycles, 2015, 2018, 2022. Same 4-stage pattern every single time. Same transfer of wealth from retail to institutions. Same outcome for those who recognized it. Now, before I show you exactly what BlackRock is doing right now in February 2026, I need to know something. Drop a comment and answer this honestly. Are you currently positioned in Bitcoin? Are you in profit or at a loss? Are you holding or did you sell during the recent dip? No judgment. I just want to understand where this community stands, because what I'm about to reveal next will either confirm you made the right decision or show you exactly why you need to reposition immediately. If this is making sense so far, if you're starting to see the big picture, hit that like button. And if you haven't subscribed, do it now, because the next section reveals BlackRock's exact playbook using live February 2026 data. This is the most important part of the entire video. Now let me show you why February 2026 is stage 2, happening right in front of your eyes, and why BlackRock is the main character this time. The smoking gun data, February 6th, 2026, CryptoQuant records the largest single-day inflow to whale accumulation addresses of the current cycle, exactly 66,940 Bitcoin. At an average price of $70,000 per Bitcoin, that's $4.686 billion moved in 24 hours. Not projected, not estimated. Actual on-chain transfers you can verify on any blockchain explorer right now. Where did it come from? 70% originated from 3 exchanges. Binance, Coinbase, and OKX dominated the outflows. But here's what's critical. These weren't spot market purchases that would have driven the price up. These were direct transfers. Bitcoin leaving exchange hot wallets, moving to cold storage. Where did it go? Glassnode's wallet classification shows 55% went to illiquid accumulator addresses. These are wallets with zero transaction activity in the last 30 days. This is classic institutional HODL behavior. Sovereign wealth funds, corporate treasuries, they're not trading this Bitcoin. They're storing it for years. Another 25% moved to Coinbase Prime custody. This is institutional grade custody for high net worth clients and institutions. And here's where BlackRock enters the picture explicitly. On February 9th, 3 days after the massive accumulation day, BlackRock linked wallets transferred $247 million in Bitcoin and Ethereum to Coinbase Prime. This is public blockchain data. The wallet addresses are known. But here's the paradox that proves the strategy. While this accumulation was happening, Bitcoin spot ETFs had net outflows of $1.6 billion. How do you reconcile massive accumulation on-chain with ETF outflows? The answer reveals BlackRock's entire playbook. BlackRock is doing something brilliant and completely legal. They're selling paper Bitcoin through ETFs while buying physical Bitcoin through OTC markets. When retail investors buy Bitcoin ETFs, they're buying shares of a fund that holds Bitcoin. They don't own the Bitcoin directly. They own paper exposure. When they panic and sell those ETF shares, BlackRock can facilitate those sales, collect management fees, and simultaneously buy the actual Bitcoin at depressed prices. The Coinbase Premium Index hit negative 167.8 in early February. That's massive institutional selling pressure on Coinbase's exchange, but the same days, accumulator addresses had record inflows. They're selling high through regulated ETF products and buying low through OTC desks. Here's the genius. ETF outflows create negative sentiment. Headlines scream institutions abandoning Bitcoin. Retail sees those headlines and panics more. The price drops further, and BlackRock's OTC desk buys more physical Bitcoin at better prices. Rick Reeder, BlackRock's chief investment officer, is publicly on record saying Bitcoin will replace gold. This isn't some crypto bro speculating. This is BlackRock's CIO making a strategic call. BlackRock and Fidelity combined now hold over 1 million Bitcoin in cold storage custody. That's 5% of all Bitcoin that will ever exist. If your mind is blown right now, if you're realizing that everything you read in mainstream financial media is designed to get you to do exactly what benefits BlackRock, you need to hit that like button immediately. This is information they don't want easily accessible. Comment below, did you know BlackRock was doing this? Did you understand the difference between ETF flows and actual on-chain accumulation? Most people don't. That's why they keep losing money to the same pattern every cycle. And listen, if you value this level of research, subscribe right now and turn on notifications. Because what I'm about to show you next is how they engineered the price to maximize this accumulation. This is where it gets ruthless. Now, let me show you how they engineered the price action to maximize accumulation. This part makes people angry because it reveals how calculated this process is. Liquidation heat maps from CoinGlass for the last 2 weeks show two massive clusters. Below $69,000, there's a dense concentration of long positions. Between $65,000 and $60,500. Approximately $800 million to $1.5 billion in potential forced liquidations. Above $69,000, there's a cluster of short positions between $72,000 and $78,000. About $500 million. And a mega cluster at $80,000 to $82,000 worth over $1 billion. So what do institutional players do? They execute what's called the sandwich strategy. First, they push the price down through coordinated selling, triggering long liquidations at $60,000. Retail traders using leverage get stopped out automatically. Whales absorb all that forced selling. They're the bid at $60,000. Then, once they've accumulated enough supply, they push the price back up, squeezing short positions at $72,000. That buying pressure drives the price higher, triggering more short liquidations above $75,000. The result? Bitcoin transferred from leveraged retail traders to institutional spot holders. And the proof this is happening? Order book data shows consistent bid walls around $69,200. Approximately 20 Bitcoin, about $1.38 million in size, absorbing every dip. The floor is defended, the ceiling is managed, and retail gets liquidated on both sides while institutions accumulate in the middle. And here's the macro backdrop that makes BlackRock's timing even more calculated. On January 28, 2026, the Federal Reserve held interest rates at 3.5% to 3.75%. Jerome Powell signaled few rate cuts in 2026, maintaining a hawkish stance. Mainstream financial media narrative? High interest rates are bad for Bitcoin. Sell everything. And retail believed it. They sold. But look what BlackRock did the week after Powell's hawkish comments. February 9th, $227 million moved to custody, all documented on-chain while the media was telling people to de-risk. Why? Because BlackRock sees what most retail investors miss. U.S. national debt just crossed $38 trillion. Annual interest payments on that debt now exceed $1 trillion per year, more than the entire defense budget. The debt is structural. Bitcoin is a hedge against exactly that scenario. And BlackRock knows it. The Fed's hawkish rhetoric is the cover story. It scares retail into selling. BlackRock's accumulation is the real story. The smart money doesn't react to headlines. They position based on mathematical inevitability. If you're angry right now, if you're realizing the game is rigged and you've been on the losing side, channel that anger productively. Hit the like button. Share this video. Comment below and tell me, does this change how you see Bitcoin? Does this change how you see financial institutions? Because the only way we level the playing field is by spreading information like this. The institutions have Bloomberg terminals. We have blockchain data and pattern recognition. Use it. Subscribe if you want more content like this that exposes what's really happening. Because I'm about to show you the final piece of evidence that proves this is a coordinated transfer of wealth. This is damning. Now let me show you the most damning evidence that this is a calculated transfer of wealth. Short-term holders, defined as wallets that acquired Bitcoin in the last 155 days, sent over 100,000 Bitcoin to exchanges between February 4th and 6th. CryptoQuant data shows 54,000 Bitcoin moved to exchanges on February 2nd alone. Shrimps, the category for wallets, holding less than 1 Bitcoin, sent over 1,000 Bitcoin to exchanges in a single day. That's a record. Total realized losses for short-term holders during this period exceeded $2 billion. That's actual losses locked in by people selling lower than their purchase price. At the exact same time, whales holding over 1,000 Bitcoin accumulated 70,000 Bitcoin. The accumulation trend score hit 0.68, confirming that long-term holders increased their net positions by 4% to 5% in a single week. Miners sent 90,000 Bitcoin to Binance during this period, and institutional whales absorbed every single coin. The bid was there, ready, waiting. This is the transfer. Weak hands capitulate, strong hands accumulate. And historically, when the accumulation score stays above 0.65 for 60 plus consecutive days, Bitcoin rallies 70% to 370% in the following 6 to 18 months. 2015, 100% rally within 8 months. 2018, 230% rally within 6 months. 2022, 370% rally within 16 months. We're approximately 30 days into this accumulation phase based on when whale activity accelerated. If the historical pattern holds, we have another 30 to 150 days of stage 2, before compression and then explosion. Real talk. Comment below right now and answer honestly. Have you been the short-term holder who panic sold? Have you been the person who sent Bitcoin to an exchange at a loss? There's no shame in it. We've all been there. I want to hear your story because this community learns from shared experiences. If you've made it this far in the video, you clearly value deep research and real data. That deserves a like. Hit that button. It takes 1 second and helps more people find this information. And if you're not subscribed, seriously, what are you waiting for? The next section gives you the exact action steps based on where we are in the cycle. I know exactly what you're thinking right now. But the ETFs are bleeding money. That proves institutions are bearish. No, it proves institutions are tactical. Let me show you why ETF outflows don't mean what you think they mean. In 2022, Grayscale Bitcoin Trust traded at a 40% discount. What did smart institutions do? They sold their GBTC shares and bought physical Bitcoin cheaper. Same Bitcoin exposure. 40% cost savings. Pure arbitrage. In February 2026, the same arbitrage is happening. BlackRock's iShares. Bitcoin Trust had outflows, yes, but BlackRock linked wallets moved $247 million to Coinbase Prime. They're not exiting Bitcoin, they're rotating from ETF wrappers to direct custody. But Bitcoin is down 15% from the all-time high. That's bearish price action. In every historical accumulation phase, Bitcoin consolidates or declines. 2015, down 60% from 2013 highs during accumulation. 2018, down 84% from 2017 highs. The price drops to shake out weak hands and create fear. Then it consolidates while smart money accumulates. Then it explodes when the supply shock materializes. Every objection you have, history has already answered. So what does this mean for you practically, specifically, starting today? First, understand where we are in the cycle. We're approximately 30 days into stage 2. Historically, stage 2 lasts 60 to 180 days total. That means you likely have 30 to 150 days remaining before stage 3 compression begins. Second, monitor the on-chain signals yourself. Don't trust me, verify. If the accumulation trend score stays above 0.65 for another 30 to 60 days, we're confirmed deep in stage 2. If exchange balances continue dropping month over month, we're building toward a supply shock. Third, understand the historical playbook. Every previous cycle, those who accumulated during institutional accumulation phases, they saw 70% to 370% returns in the subsequent 6 to 18 months. Fourth, avoid leverage at all costs. Notice how institutions engineered liquidations at $60,000 and $72,000? They used leverage against retail traders. Leverage is their weapon to shake you out. They don't gamble with 10x or 20x leverage. They accumulate spot and wait. Fifth, think in supply, not price. The price is noise in stage 2. What matters is supply distribution. Sixth, verify every claim I just made. I've given you the sources. CryptoQuant, Glassnode, CoinGlass, Whale Alert. Every number in this video is backed by public blockchain data. Check it yourself. The pattern doesn't require your belief. It doesn't need consensus. It just unfolds, like mathematics, like gravity, like it has every cycle before. Now I need to know. Based on everything you just learned, comment below and tell me, what's your plan? Are you going to monitor the accumulation score? Are you going to track exchange balances? Are you going to position differently than you were before watching this video? I read every comment because I want to know this information is actually helping people. If it is, smash that like button one more time. Let's get this video to 10,000 likes so YouTube shows it to everyone. And if you haven't subscribed yet, I honestly don't know what more I can do to convince you. This is the level of research and analysis you'll get in every video. Real data, real patterns. Subscribe now. 66,940 Bitcoin, $4.7 billion, absorbed in a single day while you were panic selling. BlackRock moved $247 million to custody while ETF outflows screamed, institutions are leaving. The accumulation score hit 0.68 while the fear index hit capitulation. This is stage 2, the silent accumulation phase, the transfer of wealth from weak hands to strong hands, the same setup that preceded 100% rallies, 230% rallies, 370% rallies in every previous cycle. One last time, drop a comment below. Tell me what city and time zone you're watching from. Tell me if this changed your perspective on Bitcoin. Subscribe right now because the next video breaks down the exact on-chain indicators that signal when stage 2 ends and stage 3 compression begins, the exact entry signals, the exact exit signals, the exact risk management framework. Because here's the truth they don't want you to know. The people who profit from these cycles aren't the ones with the most money. They're the ones with the best information and the discipline to act on it. BlackRock knows this. That's why they accumulated $4.7 billion while you were reading panic headlines. The data is public. The pattern is clear. The blockchain doesn't lie. The only question is whether you'll recognize it and position accordingly, or whether you'll be asking 6 months from now how you missed all the signs when they were right there, transparent, time-stamped, and undeniable. Thanks for watching. Hit that like button one final time if you got value from this. Subscribe for more deep dives like this, and I'll see you in the next one. Remember, in Bitcoin, the real money is made in silence. The only noise is retail panic. The smart money, they move in the dark, they accumulate in the fear, and they profit in the euphoria. See you in the next one.